Close your eyes for a moment and rewind to the year 2000. The millennium bug was a distant memory, dot-com euphoria was peaking, and a crisp $1,000 bill in your pocket felt substantial. It could buy you a decent used car, perhaps a high-end computer, or fund a memorable trip across state lines. Now, open your eyes to today. That same $1,000, if you had simply held onto it as cash, would now command the purchasing power of a mere $431. More than half of its value vanished. This isn't just about prices going up. It's about a silent, insidious transfer of wealth, an invisible hand picking your pocket, operating in plain sight for decades. The question isn't if your money lost value, but where did that value go? Who pocketed the difference? This erosion isn't merely a natural economic phenomenon. It is, in large part, a consequence of deliberate policies and systemic shifts that have reshaped our financial landscape. The culprit is inflation, but not the simple kind often discussed at dinner tables. We are talking about engineered inflation, a force that systematically redistributes wealth from the many to the few, from the diligent saver to the savvy asset owner, from the individual wage earner to powerful institutions. Imagine inflation as a hidden tax, one that no legislator ever voted on, yet it impacts every single transaction, every savings account, every future dream you hold. It's a tax on the past, diminishing the value of your hard-earned savings, and a tax on the future, making everything you aspire to acquire exponentially more expensive. Central banks and governments. Consider the Federal Reserve, for instance. Its mandate includes maintaining price stability, yet its actions, particularly since the 2008 financial crisis and dramatically amplified during the COVID-19 pandemic, tell a different story. Through quantitative easing, where trillions of dollars were injected into the financial system by buying government bonds and other securities, the money supply expanded at an unprecedented rate. This wasn't merely printing physical bills, it was creating digital currency out of thin air, flooding the economy with liquidity. What happens when you vastly increase the supply of anything? Its value diminishes. In this case, the value of the dollar. This influx of cheap money served several purposes. It kept interest rates artificially low, making it cheaper for governments to borrow and finance their ever-growing deficits. It also encouraged borrowing and spending, theoretically stimulating economic growth. However, a significant portion of this newly created money didn't flow directly into the hands of the average consumer. Instead, it often found its way into financial markets, inflating asset prices. Stocks soared, real estate markets became red hot, and commodities spiked. Those who owned these assets, the wealthy institutional investors and corporations, saw their net worth skyrocket. Meanwhile, those whose primary wealth was in cash or fixed income savings watched their purchasing power evaporate. This is the first major recipient of your vanished $569, the financial system itself, and those positioned to benefit from its engineered expansion. But the story doesn't end with central bank policies. Large corporations also play a significant role in this grand transfer. While supply chain disruptions and increased input costs are genuine factors, the phenomenon of greedflation cannot be ignored. Many corporations, especially those with significant market power and less competition, have not merely passed on increased costs to consumers, they have actively widened their profit margins. During periods of high inflation, it becomes easier for companies to justify substantial price increases, often exceeding the actual rise in their operational expenses. Consumers, conditioned to expect rising prices, are less likely to resist, allowing these companies to rake in record profits. Look at the energy sector, the food industry, or even consumer goods giants. Their quarterly earnings reports often reveal profit surges that far outpace inflation, demonstrating that a significant chunk of your lost purchasing power has landed squarely in their corporate coffers and subsequently in the pockets of their shareholders and executives. Consider the housing market. In 2000, the median home price in the U.S. was around $169,000. Today, it's closer to $420,000. While some of this appreciation is due to genuine demand and population growth, a substantial portion is fueled by cheap credit and institutional buying. Large investment firms have aggressively entered the residential real estate market, buying up properties and often converting them into rentals, further squeezing the supply for individual homebuyers. This dynamic transforms housing from an attainable asset for many into an increasingly exclusive investment vehicle for the privileged few, contributing to the wealth gap and effectively transferring future wealth from aspiring homeowners to existing property owners and institutional landlords. Your $1,000 might have put a small dent in a down payment in 2000. Today, it barely covers a few months' rent in many major cities. The impact of this invisible wealth transfer is profound and deeply personal. For the average individual, it means working harder just to stay in the same place. Wages, for many, have not kept pace with the true rate of inflation, leading to a decline in real income. The dream of home ownership becomes a distant fantasy. Saving for retirement becomes an uphill battle, as the purchasing power of your nest egg shrinks year after year. The cost of education has skyrocketed, burdening younger generations with unprecedented levels of debt. Healthcare expenses continue to spiral upwards, creating financial precarity even for those with insurance. Each of these sectors represents a specific conduit through which your vanished 569 has been siphoned off, enriching a different set of stakeholders, from pharmaceutical companies and hospital systems to university endowments and student loan servicers. This constant erosion of purchasing power fosters a pervasive sense of anxiety and frustration. People feel like they are on a treadmill, running faster and faster, but never truly advancing. They see the headlines touting economic growth and record stock market highs, yet their own lived experience tells a different story. Grocery bills that demand a second look, gas prices that dictate weekend plans, and the ever-present worry about making ends meet. This disconnect creates a fertile ground for social unrest and distrust in institutions, as the illusion of prosperity masks a stark reality for a significant portion of the population. The official inflation numbers, often cited by governments and media, frequently underestimate the true cost of living increases experienced by ordinary families, particularly for essential goods and services. This statistical sleight of hand further obfuscates the scale of the wealth transfer. So what can be done in the face of such a deeply entrenched system? The first step is awareness. Understanding that your money isn't just losing value randomly, but that this value is being systematically transferred to specific entities and individuals is crucial. It changes the narrative from personal financial failure to systemic economic challenge. It shifts the focus from blaming individual spending habits to questioning the very structure of our monetary and economic systems. It highlights the importance of financial literacy, not just in terms of budgeting and saving, but in comprehending the larger forces at play that dictate the real value of your labor and your assets. This isn't an indictment of capitalism itself, but rather a critical examination of its current manifestation, where financial engineering and political expediency often override the principles of sound money and equitable wealth distribution. The $569 that vanished from your $1,000 didn't disappear into thin air. It migrated. It coalesced into higher corporate profits, inflated asset valuations, reduced government debt burdens, and increased wealth for those already at the top. It is the silent tax on your diligence, the invisible transfer from your pocket to theirs. Now consider this. If you understand how this transfer happens, you gain a powerful insight. You begin to see the world differently, not as a random collection of economic events, but as a system with inherent biases and beneficiaries. This knowledge empowers you to ask better questions, to demand greater transparency, and perhaps to make more informed decisions about your own financial future, even within a system designed to extract value. The next time you feel the sting of rising prices, remember those $1,000 from 2000. Remember its lost purchasing power and the precise mechanisms that facilitated its disappearance. This isn't just a historical anecdote. It's an ongoing process, quietly reshaping the economic destiny of millions. Understanding this truth is the first step towards reclaiming control. What are your thoughts on this invisible transfer of wealth? Have you felt this erosion of your purchasing power personally? Share your experiences and insights in the comments below, and let's uncover more of these hidden truths together. Your perspective is invaluable in shining a light on these complex financial dynamics.